Welcome to this explainer on ExxonMobil's second quarter performance for 2026. If you follow energy markets, you know things are constantly shifting. So today, we're going to track exactly how this global titan balances astronomical financial growth with some deeply complex, real-world geopolitical hurdles. Let's get right into it.
Okay, let's start with a number that is just staggering. $14.5 billion in earnings for Q2 of 2026. To put that into perspective, that's roughly $160 million in pure profit rolling in every single day of the quarter. It's a 105% jump year over year from the $7.1 billion net income they reported back in Q2 of 2025. Seeing a mature mega-cap corporation literally double its profit like that, it's exceptionally rare, and it really sets the stage for everything they're about to unpack. Now here's where it gets super interesting, because those massive top-line numbers actually mask a bit of a bottom-line reality check. Look, revenue hit a mind-blowing $116 billion, absolutely crushing Wall Street's expectations. But adjusted earnings per share, they actually missed targets by about 4.3%. The main culprit here? Geopolitics. Conflicts in the Middle East temporarily knocked 10% of their upstream production completely offline. As CFO Neil Hansen pointed out, they saw extreme swings in commodity prices that were just really tough to model. It's a perfect example of how global instability can still nick your bottom line, even during a record-breaking revenue run.
Rewarding the shareholders. Consistency amid the chaos.
Even with that slight earnings miss we just talked about, the sheer volume of cash they generated tells a really lucrative story. In just 3 months, ExxonMobil returned $9.4 billion to shareholders. That's split right between direct dividends and share repurchases. This aggressive payout strategy keeps them perfectly on track to hit a massive $20 billion repurchase goal for the entire year.
But honestly, this next metric is what long-term investors, everyone from institutional fund managers to your average retirement account truly care about. They just declared a new third quarter dividend, which cements a 43-year streak of absolute reliability. Think about that. 43 consecutive years of raising payouts, growing at an average rate of 5.8%. It shows a deep, fundamental commitment to handing cash back to shareholders, literally no matter what the global economy throws at them.
Global growth engines, the physical assets driving the wealth.
So you might be wondering, where exactly is this $17.2 billion in quarterly free cash flow actually coming from? Well, we have to look down to South America. Down in Guyana, ExxonMobil achieved a speed-to-market victory that is basically unheard of in the oil industry. They have already fully recovered a $55 billion investment along with operating costs, nearly 2 years ahead of schedule. At the exact same time, gross production from their Stabroek block hit an unbelievable 900,000 barrels per day during the second quarter.
And get this, they are nowhere near hitting the brakes. Back in June, their fifth floating production storage and offloading unit, or FPSO, set sail. It's named Ariel Witu, which means abundance, and this massive facility is going to add another 250,000 barrels per day once it goes online in the fourth quarter of 2026. That is going to push their total output near 1.2 million barrels a day before the year's even over. And looking ahead to late 2027, they plan to have 6 of these vessels running. It's a literal growth engine.
Meanwhile, back in the U.S., their Permian Basin operations are shattering records, pushing past 1.8 million oil-equivalent barrels per day. The engineering behind this is just wild. In just 6 months, they drilled over 84-mile laterals. That means they are drilling horizontally, underground, for 4 straight miles just to tap into resources faster and cheaper. It's a huge technological leap, driving efficiencies that allow them to target a 9% compound annual growth rate all the way through 2030. Combined with what's happening in Guyana, this pushed Exxon to its highest upstream production in over 2 decades if you exclude the Middle East. Of course, pumping out volume is only half the equation, right? Defending your margins is the rest of the game. Thanks to these crazy efficient techniques, ExxonMobil has squeezed out $16.3 billion in structural cost savings since 2019. To put that in perspective, that actually beats the savings of all the other international oil companies combined. And they're not stopping. They're aiming for $20 billion in cumulative savings by 2030. High stakes and headwinds, navigating turbulent global waters.
But look, an operation of this magnitude doesn't just exist in a vacuum. Right now, in what is basically a massive geopolitical poker game, ExxonMobil has proposed an $80 billion joint investment to expand Kazakhstan's Kashagan oil field. Working alongside state-owned Kosmonaya Gas, they're targeting a field holding an estimated 16 billion barrels of recoverable reserves. If they pull this off, it could pump out up to 600,000 barrels every single day.
But, and this is a huge but, there's a catch. ExxonMobil is strictly conditioning this massive investment on the Kazakh government settling a $150 billion revenue dispute over past development delays, plus a separate $5 billion environmental fine regarding sulfur storage. So Exxon is tying the launch of this brand new project directly to clearing up past legal baggage. It's a very aggressive leverage play, and honestly, getting that political approval is far from a sure thing. On top of that standoff, the company is fighting some pretty formidable macro headwinds. Global supply chains are incredibly stressed right now, largely due to ongoing conflicts involving Iran and some major disruptions to critical shipping lanes right through the Strait of Hormuz. And internally, they're also eating the high costs of recent refinery maintenance, plus higher depreciation from all these heavy investments they've been making.
They're also navigating some shifting political winds right here at home. Back in early August, former President Donald Trump publicly called on oil giants to return profits to the public to combat high fuel prices, basically saying they were making too much money. This really highlights the intense bipartisan political heat that naturally flares up anytime a major energy company posts record profits, while everyday consumers are dealing with elevated costs at the pump.
So, with all these conflicting winds and heavy headwinds, how is Wall Street actually digesting the news? Well, sentiment is a bit mixed, but it definitely leans positive. Firms like TD Cowen and Bernstein are holding on to their buy ratings with some pretty aggressive price targets at $168 and $182. DZ Bank is playing it a little safer with a hold at $156. Ultimately, though, the broader market really seems to be rewarding their strategy. Shares have jumped nearly 45% over the past year, which significantly outperforms the wider industry.
Through all this noise, leadership is keeping their eyes glued to the horizon. As CEO Darren Woods put it, ExxonMobil is not built for one market, one quarter, or one set of conditions. It is built to lead as markets evolve. Basically, they're betting that their deep structural advantages in places like Guyana and the Permian will ultimately power right through any temporary geopolitical friction.
Which leaves us with one final thought to chew on. In an increasingly volatile world, how exactly will ExxonMobil maneuver these record-breaking assets to stay ahead of the next big storm? Will their high-stakes gamble in Kazakhstan actually pay off, or will shifting political winds force them to rewrite the playbook? The global chessboard is always moving. Thanks for joining this explainer. Until next time, keep analyzing and keep learning.